Welcome to KNN. KNN is brought to you by Bob Knakal, Chairman of New York Investment Sales at JLL.
Hi, I'm John Hageman, Managing Director at JLL. Welcome to KNN. Today I'm here with Bob Knakal, Chairman of New York Investment Sales. And today we're going to talk about the 2022 outlook for the New York investment sales market. So Bob, in the last episode we talked about the overall numbers for 2021. Today I want to talk about the outlook for 2022, but why don't, for the viewers, you give a recap of just the brief numbers that we saw just in the Manhattan market for last year.
Yeah, 2021 investment sales over $10 million. The market was completely bailed out by fourth quarter activity. Through the first three quarters, we were on pace to end up below $10 billion for the year, which would have been even worse than the $11.1 billion we had in 2020. But the $6.8 billion of sales volume we had in the fourth quarter was up 26% from what we had in 2020. So we finished with a very strong fourth quarter, leading to a better 2021 than in 2020. Number of properties sold, fourth quarter again bailed the year out. 65 sales over $10 million, 167 for the year. That was up 61% from the 104 that had sold in 2020. So both of these metrics were up, they were positive, well below the peak of the market in 2015, where we had $57.5 billion in sales volume, 484 buildings sold. So we still have a long way to go, but thank goodness the fourth quarter was as robust as it was, because it really pulled us out and ahead of 2020, and we think there are blue skies ahead.
Great to hear. So what are some of the factors that we're thinking about for 2022 and things that we are really paying attention to?
Hags, there are a number of things we need to focus on. And clearly, if we look at historical averages, we go to 40,000 feet, look at peaks and troughs and reversion to the mean and all those kind of things, you would say, well, after such a long correction that we've had, the market has to just move on and move up. Every successive peak of each new cycle has greatly exceeded the peak of the past cycle. Will that happen again? How will the market proceed? All things being equal, we should be on a great run for several years with increased dollar volume, increased number of properties sold, increased property values. The things that could impact that, derail it, change it, there are several. Interest rate policy is one, tax policy is another, local rent regulation that impacts our multifamily market, which is predominantly the largest percentage of properties in the city. So there are a number of things that we need to keep a very close eye on to figure out how the market is going to move forward.
Let's talk about one thing that what we've been discussing with clients recently that we haven't felt like there's been enough talk about so far is interest rates. What are we hearing so far, and why is that important so much for our market?
One of the most interesting things about interest rates is that if you think about it, we're now about 14 years into historically low rates. Since 2008, rates have been so low. And to think that we went through a 66-month investment sales market correction where the volume of sales dropped by almost 80%, to have that occur in a market where interest rates are so historically low is really, really remarkable. And something that I think will be written about years and years in the future, how we went through this period. But there is upward pressure on interest rates. If you look at what's happening in the broader economy, the economy is not doing fantastically well. We have things that are impacting the way the economy is working. We have inflation at a 40-year high. And so the Fed has to raise rates to curb inflation. The Fed's comfort level with respect to inflation is generally between 1% and 2% a year. We're running at 7%. So some bankers have indicated that they expect to see the Fed increase rates 4 to 6 times this year. So what does that mean? Does that mean a 75% or 75 basis point increase in rates, or 1.5% or 2%? No one really knows that, but clearly that's going to have an impact on the market. So I think the extent to which rates rise and how quickly they rise could have a very tangible impact on the marketplace.
Bob, you mentioned tax policy. What are some of the things that we're paying attention to there?
You know, tax policy also has an extraordinarily profound impact on the activity of sales volume. If we look back over the past 38 years, 3 of the top 5 years in turnover were precipitated by changes in the tax law. And we were concerned with the rhetoric leading up to the current administration's policies that we might see a big tax increase on the capital gains tax front, that 1031 exchanges might get modified. Because of the inertia that seems to be taking over Washington at the moment, those are less of a threat than they were many months ago, but still something we're keeping an eye on. But on the policy front, I think, you know, interest rates, what the Fed does, that's probably more impactful than potential capital gains tax increases or 1031 modifications at this point.
Bob, that's the federal level. What about on the local level in particular?
Locally, we have several factors that we're going to keep a close eye on. The rent regulation policy is one. You know, in June of 2019, we had very, very significant changes to our rent regulation laws, and that had a big impact on the market. There's a lot of talk about different proposals to further go against owners' interests, things like good cause eviction, which the industry refers to as universal rent control, that would compel an owner to give a free market tenant a renewal lease. There'll be a cap on how the rent could be increased. That's something we're keeping an eye on. And the other thing we need to be very mindful of is what's going to happen with the 421A regulation. It was part of the governor's proposed budget, which came out yesterday, and it was great to see that there was an inclusion of a new iteration of 421A that was part of the proposal. I think it's 485W or something like that. So different name, but same type of program. And you know, tenant advocates say that these programs, the 421A and Affordable New York, were a tremendous waste of taxpayer dollars. But the reality is that the overwhelming majority of rental housing would not be built without this program. We desperately need rental housing. We need affordable housing, workforce housing, all kinds of housing. You look at what's happening with upward pressure being exerted on rents these days, and that's due to the fact that our supply is not growing as much as it should be. So we need the construction of those new units. Hopefully the 421A new iteration gets adopted sooner than later, because right now we have an air bubble in the supply pipeline because land has not been selling for the last couple of months because developers knew they couldn't get a footing in the ground to qualify for the program. So from a rental construction perspective, there is an air bubble that has been created and is inflating day by day. So the sooner we can get that tax abatement program back on the books, the better it'll be for the industry. But that's another thing that we're keeping an eye on that will be very, very impactful, particularly on the land sale business.
So generally, Bob, there's certainly things to be mindful of, but it sounds like you're pretty optimistic about things for 22.
Yeah, no doubt about it, Hags. I think that we are, if we go back in time to the last cycle, I think we're presently in like the 2010 or 2011 of that cycle, so maybe second inning, third inning of where this cycle is going to go. There are things out there that could be landmines for the market. Hopefully we avoid those. But I really feel optimistic that the next 3, 4, 5 years could be a great run for the New York City investment sales market.